Okay, hi there, everybody. I am doing this recorded lecture for Chapter 6 of our Accounting for Payroll textbook. And so in Chapter 6, we kind of bring everything together with the payroll register that we've been working on. And then we look at the journal entries to record both the salary or wage expense is the first entry, and then the payroll tax expense on the employer side of it is the second entry. And then we look at some of the adjusting entries at the end of the year, for example. So I'm going to share my screen with you and get the Chapter 6 PowerPoints pulled up. Okay, so Chapter 6, again, analyzing, journalizing payroll. And so, again, we're still working with that payroll register that we have been getting practice with and kind of filling out in each chapter. And so now we're gonna, kind of finish it off, look at the journal entries, again, to record the employee side, which is the salary or wage expense, and then the employer side, which is the payroll tax expense. And so we're going to look at both of those together, and then the adjusting entries and some of the other things that we do. Okay, so learning objectives for this chapter: record payrolls and payroll registers and post to employees' earning records. Identify the various deductions, both voluntary and involuntary, taxes and garnishments that are taken out of an employee's gross pay. Journalize the entries to record the payroll and payroll taxes. Post the various general ledger accounts that are used to accumulate information from the payroll entries. Explain the recording of the payroll tax deposits. Explain the need for end of period adjustments. And so accounting for payroll transactions, we've looked at the payroll registers and the employee earnings records before. Remember, the payroll register includes all employees, right? And the employee's earning record, this is the individual, right? Individual. So each employee has his or her own earnings record, right? And remember, if we remember seeing these, they have the same columns, like you know, total earnings, overtime regular earnings, overtime earnings, gross earnings, the taxable wages column, the tax column. So the payroll register, the employee earning record, very similar. It's just payroll register is for all the employees, where the employee's individual earning record is just for that employee. And then again, some of these entries that we have to do. So we have to do a journal entry to record gross payroll and withholding. So this is from the employee side. And so essentially what we're doing, and we're going to see examples of these entries as we go through, but essentially what we're doing is we're debiting salary and wage expense and then crediting all of the taxes and deductions that we took out. The second one, journalized payroll taxes and workers' compensation insurance expense. Again, this is the employer side. And so this entry is a debit to payroll tax expense, and then usually a credit to any of the taxes that have to be paid. Journalized deposit and payment of payroll taxes. This is simply like for example, when we did the first entry, we credited FICA payable $50 or whatever, right? So to journalize the deposit and payment, then we would debit FICA payable, credit cash type deal, right? So, and then end of period adjustments. We've done these plenty of times together before. This is where, payday or the last day of the year does not fall exactly on payday. And so we have to accrue some wages. And so this is where we do like debit, wage expense, credit, wages payable type deal. And then, of course, as we know, all of our entries get posted to the ledger accounts. Okay, so the payroll register, so employees are listed in rows and the following information recorded for each of them. Again, the hours they work, their time record, the regular earnings, overtime earnings, total earnings, taxes withheld and other deductions, again, other deductions, health insurance, charitable contributions, retirement calculations, right? Things like that. Net paid and taxable earnings. And then it is telling us that there's an example of this in your book on pages 6-1, 6-2. When completed, should foot and prove payroll register by ensuring that columns and rows all total to bottom right-hand number. The bottom right-hand number is the net pay. Alternatively, we could do a manual proof, but most companies use an electronic system. All right, employees' earnings record. Again, these are for the individual employees, so supplementary record prepared for each employee. Provides information that is used to prepare the payroll register, prepare reports required by state unemployment compensation or disability laws, determine when the accumulated wages of an employee reach the cutoff level for FUTA, SUTA, or Social Security taxes, prepare payroll analysis for governmental agencies and internal management reports, settle employee grievances, provide details to issue W-2s, and just like it shows here, with payroll software, the above functions, occur instantaneously, oftentimes directly from a timekeeping system. So, essentially the timekeeping system, feeds to our payroll system to say how many hours were worked, and then everything's calculated automatically. So that's nice, but it's good to know kind of what's going on in the background anyway. Okay, so recording gross payroll and withholdings. So total gross payroll is debit portion of payroll entry. And like we said, we usually debit wage expense or salaries expense. And if there's multiple departments, they might break it down. We might have like wage expense for research department or wage expense for technology department, right? But that's the total debit. And so this is the debit of gross wages, right? So this is the debit of the gross wages before we take any tax, before we subtract our numbers basically. And then just like it shows here, each major withholding tax is credited to a liability. So for example, FICA, Social Security, payable type deal, or federal income tax payable or state income tax payable, whatever the tax is. All other payroll deductions are liabilities as well and are lumped together under other deductions, which is credited. So some purposes of other deductions, group insurance premiums, which we're going to talk about more, health insurance premiums or health saving account deductions, purchase of government savings bonds, union dues, garnishment of wages, pension and retirement contributions. So group insurance permits employees to obtain life insurance at a much lower rate than if purchased by the employee individually. And then under some plans, the employer and the employee share the cost of the insurance premium. I know at the company I used to work for, they had a group insurance plan, and basically for $0, we got 25,000 of coverage. And then if we wanted, and so that's what the employee, or excuse me, that's what the employer paid, right? Because we didn't pay anything for it. We automatically got 25,000 of coverage. But if we wanted more than 25,000 of coverage, because again, this is life insurance, right? If we wanted more than $25,000 of coverage, we had to pay the additional cost on top of that. So total amount withheld is credited to a liability account with the title group insurance premiums collected or group insurance payments withheld. Liability account is debited when the premiums are paid, right? Because then we would debit the liability credit cash type deal. Okay, health insurance is another potential deduction. Again, companies can either develop their own health insurance plans or be part of a private insurance group that then provides coverage for the employees. Amounts withheld from employees' wages for health insurance are credited to a liability account, such as health insurance premiums collected. If withholdings made for a qualified benefit under an IRS approved cafeteria plan, premiums are not included in taxable income. Employer's portion of premium is often paid in advance and debited to prepaid health insurance. Okay, purchase of government savings bonds. Employees encouraged to invest a certain amount of their wages in these bonds. Employees complete savings authorization forms and indicate the amount to be withheld for such purchases. Amount withheld sent to employers' treasury direct accounts set up by employees. Employees decide the value and type of bonds to be purchased. And, generally speaking, too, federal bonds are not, or I guess I should say not federal bonds, but the interest on federal bonds is not taxable. Usually at federal or state level. But, states differ. I know for sure at the federal level. Okay, union dues. Employees who are members of unions pay dues, assessments, and initiation fees to the union through deductions from wages. Withholding amounts are credited to a liability account such as union dues payable, recorded by debiting liability account and crediting cash account. So I don't know. This, I think this would be a little bit, maybe if we said record payment, like when we pay the union hall or whatever, right? Because initially it would be, again, the debit would be to wage expense or salary and wage expense. We would credit union dues payable. And then once we paid it, then we would debit union dues payable credit cash. So. Okay, garnishment of wages. So garnishment of wages are when wages are taken out of the employee's check for a debt that is owed. So just like it shows here, a creditor can, through the courts, seek repayment of his or her money by garnishment. Employer is required to comply with garnishment's orders. Employer must withhold funds from employee's paycheck and submit it to appropriate authorities. Ignoring a garnishment order means the employee's debt becomes employer's debt by default judgment. Priority withholding orders applies to these wage attachments. So bankruptcy, federal tax levy, child support, creditor student loan, or federal administrative wage garnishments. Consumer Credit Protection Act limits the amount of wages subject to garnishments. Percentage of wages subject to garnishments are dependent on the type of garnishment, whether it's, for example, student loan debt or child support debt. The maximum amount of disposable earnings that can be garnished for debt repayment is the lesser of 25% of disposable earnings for the week, or the amount by which disposable earnings for the week exceeds 30 times federal minimum wage rate. Social Security Administration can garnish without court order delinquent overpayments owed by former beneficiaries of Social Security programs. So, child support, the Family Support Act requires immediate withholding for child support payments. Employer can withhold a state mandated fee for administrative cost. All states except South Carolina use electronic income withholding order portal. Takes precedent over most voluntary and involuntary deductions. The maximum amount that can be withheld from a person's weekly disposable earnings varies between 50 and 65% of disposable income, depending on other obligations and number of weeks that the employee is in arrears. So basically, back pay, right? Kind of like back child support owed in arrears. Okay. Odes. Whatever. You guys know what I'm saying. Okay. Okay, federal tax levy takes second priority after wages withheld for child support garnishment that was received prior to tax levy. The IRS uses Form 668W, Notice of Levy on Wages, Salary, and Other Income to notify employer of a tax levy. Copies of the form forwarded to employee to complete statement of filing status and exemptions. Tax levy takes effect within 3 days from the receipt of the tax levy notice for the first wage payment. Pension and retirement contributions. Some plans are financed solely by the employers, and some require employee contributions. Pension plans that involve employee contributions result in a liability for the employer. These are recorded in the payroll entry. Again, we're debiting salary, wage expense, crediting, for example, retirement contribution payable or whatever, right? Pension Protection Act of 2006 gives company ability to enroll employees in a company's plan and deduct contributions from pay. Employers can also set up IRA accounts for employees through a payroll deduction plan. And again, they're recorded as a liability because the company has to turn around whatever they withheld from the employee's paycheck for retirement. They've got to turn around and pay that to the, wherever they have their retirement accounts set up, Edward Jones or whatever, right? Okay, methods of paying wages and salaries. So cash, checks, or electronic fund transfer system. Electronic records created showing bank account number and net pay for each employee. Some states have prohibited employers from requiring employees to receive pay through the electronic funds transfer system. Some employees don't have bank accounts, for example. So in that case, pay cards allow the employer to deposit payroll into a prepaid card. It's similar to a debit or credit card. And again, this can be used by employees who do not have bank accounts. And it's a little bit more economical for the employer than paper checks. Electronic pay stubs alleviate need for paper pay stubs. And usually, the electronic pay stubs, I know it was this way at Lindenwood, it's this way at William Woods, is that we can go online and access any pay stub, that we want to look at. And then final pay, most state, so this is when an employee leaves or is fired, their final paycheck. Most states set time limits between termination and final payout, depends upon whether worker left voluntarily or was terminated. California and Michigan require immediate payment if employee is fired. Federal law does not require payments to workers for their stored up vacation time. Several states have such laws. So, I know that like when I left Lindenwood, I had a couple weeks vacation stored up. So I basically got like a couple extra paychecks, and so I know that it's happened to me before anyway, but I guess it's not a federal mandate or federal law. But some states again have laws like that. Okay, unclaimed wages is when an employee whose employment has been terminated or who terminates employee does not claim his or her final wage payment. Then the employer must follow the protocol for abandoned property. So the unclaimed property is subject to state laws. Um, Exercise due diligence and send certified letter to employee's last known address. Most states require that within 1 year the money be surrendered to the state. The state holds the funds until the employee or heirs claim the funds. If audit of a firm's compliance program finds it inadequate, it results in interest, penalties, and criminal prosecution. So we have to do our best to try to get them the rest of their money. Okay, so the entries to record the wages and payroll taxes. Again, journal entry number one is basically, you could think of this like from the employer side, or excuse me, employee side of the transaction, right? So this is from the employee side. So we're recording, salary or wage expenses, the debit, crediting all of the taxes and deductions. The journal entry number two is from the employer side. So we're debiting payroll tax expense, crediting, any of the deductions or taxes that have to be paid. These two journal entries are always in the same format. Employee must record both journal entries every time they issue any paycheck. For example, even if cutting a check for 1 day's wages, there's always two sides of the transaction, right? Okay, so here's an example of that first one. Again, we're debiting wage expense for the gross, crediting each withholding accounts, because again, these are liabilities to the employer because the employer has to turn around and pay that money to the proper agency. And then we credit cash or salary wages payable for the net amount. And so that's what we see here. So here's our gross, right? Here's Social Security. Here's health insurance, right? Here's federal income tax withheld, state income tax withheld, insurance, and then again, that net pay. And generally speaking, I mean, I know they have it a credit to cash here, but if it's wage expense, usually we would say wages payable because again, generally speaking, we don't record payroll the day the employees are getting paid, right? Usually we do payroll a week in advance or something, and then they get paid the next week. So it stays in wages payable until payday, right? Okay, journal entry number two. This is to record the employer payroll tax expense. So again, we're debiting payroll taxes as you see there. And then the credits are to all of the, FUTA payable, SUTA payable, Social Security payable, Medicare payable type deal, right? All right. Of course, you guys know that once we do our journal entries, they get posted to the T accounts. And the T accounts, or those ledger accounts, are what make up our general ledger, right? And the general ledger is what includes the final balance, essentially, that we use to prepare some of our different reports, right? W-3, for example, we use the employee's individual earning record for W-2s, but several of these different forms, the 941, the 940, right? Several of these different forms that we have to prepare. Okay, workers' compensation insurance. So again, this is for an employee to protect employees when they're hurt on the job. So this is an expense for the employer who is required to purchase insurance to protect employees against work-related injuries or disabilities. Laws differ by state, but most states do have laws in place for workers' compensation. Premiums often calculated based on employment classification. In other words, the more dangerous job you have, the higher workers' comp insurance is going to be, basically, right? Stated in terms of $100 of weekly wages paid to employees. the amount of premium debited to workers' compensation insurance expense. Employers estimate and pay premiums in advance. At year end, all payrolls are audited. Employer pays additional premium or receives credit for an overpayment. Okay, recording the deposit of payroll taxes. Again, when we recorded the initial payroll entry, it was from the employer side, right? Um, it was a debit to, um, payroll taxes, credit to all of these FICA taxes payable, federal income tax payable, right? All this jazz. Now that we're paying these, we're debiting these accounts, crediting cash, right? And same thing for here. We're debiting state income taxes payable, crediting cash. We're debiting SUTA taxes payable, crediting cash. What, honey? Okay, well, I'm almost done, sweetheart. Okay, and then end of period adjustments. Again, we've seen some of these before, right? We call this the accrued wages. And so this is when, for example, it's December 31st, we've got to close our books out, but it's not payday yet. So we have to do an adjusting entry for what employees have earned up to that time period. End of period adjusting entries are necessary when the fiscal or accounting period does not agree with end of payroll period. And so we've done this one. I know you guys have done this one together several times. And then when there are, for example, vacation benefits, we would need to debit vacation benefits expense, credit vacation benefits payable. And then also post-retirement benefits such as healthcare and pensions also require adjusting entries. Okay, that was our last slide. Let me stop sharing this screen. Hi there, guys. Okay, so yeah, just like we usually do, once we start getting practice with this in class together, we'll get practice with these entries. Hopefully we remember them. I know we did these entries in Principles of Accounting 2, Chapter 7 and 8, Principles of Accounting 2. So hopefully everybody remembers these from Principles, but either way, we're going to get lots of practice with them together. So, as always, once you guys have a chance to view this or read the chapter, let me know if you have any questions, and I'll see you in class. Bye-bye, guys.